Welcome to The Explainer. Today, we're diving into the domino effect within markets, and specifically, what happens when the financial system breaks down. You know, we usually picture these financial meltdowns as sudden, chaotic disasters happening on a loud trading floor. But the truth? Massive market crashes actually start from something that seems completely, 100% harmless: extreme optimism. Let's get right into it.
Take a look at this quote. Every financial crisis begins with something harmless: confidence. It's kind of eerie, isn't it? Just this unwavering belief that prices are going to keep going up, that borrowers will always pay us back, and that cash will always be flowing. It's the quiet, almost invisible starting point for massive systemic risk. Because let's be real, nothing makes financial markets do dumber things than a long stretch of cheap money and good news. It is literally the calm before the storm.
Section 1. The Setup, Anatomy of a Boom.
During an economic boom, our appetite for risk just explodes. We enter this really powerful, self-feeding cycle. Step 1, you've got aggressive borrowing, which fuels Step 2, massive spending. That spending drives Step 3, rapid economic growth, which ultimately inflates asset prices in Step 4. And those rising prices? Well, they create even more collateral, sending everyone right back to Step 1 to borrow even more. The whole cycle just spins furiously, encouraging super aggressive expansion, right up until someone finally stops to ask a very dangerous question. Wait, what happens if prices actually stop rising?
Which brings us to Section 2, the multiplier, the leverage trap. Now, we probably all know what leverage is, right? Using borrowed money to increase the size of an investment. But in the anatomy of a crisis, leverage is the ultimate financial trap. Sure, it's absolutely fantastic on the way up. But when an entire financial system becomes highly levered, a tiny, localized issue can instantly mutate into a massive, catastrophic contagion. Let's put this into perspective. Imagine you have 10 lakh rupees of capital. If you don't use leverage, a 10% gain nets you 1 lakh. Pretty great. But with leverage, you take that same 10 lakh, borrow another 90 lakh, and now you control a massive 1 crore position. A 10% rise there means you literally just doubled your initial capital. The returns are completely intoxicating. But actually, think about the flip side. If that 1 crore investment drops by just 10%, well, your loss is 10 lakh. That relatively small market correction instantly wipes out your original capital entirely. Boom, you are liquidated.
And when this kind of leverage saturates a whole market, it inflates a massive bubble. Fundamental value completely forgotten. People start buying assets not for what they're actually worth, but purely because they believe someone else is going to pay more for them tomorrow. The entire system's survival becomes entirely dependent on one very fragile expectation: perpetual growth.
Section 3. The Catalyst, the first crack. It all starts with a localized failure. Maybe a company misses a debt payment, or an asset class suddenly stalls out. Instantly, trust disappears, and we hit what's called a liquidity freeze. See, financial markets run on trust. When that trust evaporates, institutions panic and hoard cash because they don't know who's holding the bad debt. Assets that seemed super easy to sell yesterday suddenly have absolutely zero buyers today. Everything just seizes up because everyone is terrified, just waiting for someone else to make the first move.
Moving on to Section 4. The Cascade, the Domino Effect.
This is where the true domino effect within markets really kicks into high gear. Picture this. Bank A has massive exposure to a highly leveraged company, let's call it Company B, that suddenly collapses. Bank A takes a huge loss. To survive, Bank A instantly panics and freezes all its lending to protect itself. Now, perfectly healthy companies are suddenly denied the short-term credit they desperately rely on just to keep the lights on. Because of that, they're forced to sell off their own assets at fire sale prices, which crashes the broader market. One localized failure literally forces the next domino to topple, and then the next, and the next.
And that leads us to Section 5. The real-world fallout.
Because this doesn't just stay on a computer screen on Wall Street. The domino effect crashes right into the real world. Finance is basically the plumbing of the real economy. When credit freezes, the devastation is breathtakingly fast. Businesses cancel their expansions, factories reduce production, companies stop hiring, everyday people lose their jobs, and then, of course, consumers spend less. The contagion moves straight from the trading floor directly into our neighborhoods. And remember, modern finance is intensely global. Capital moves at the speed of light, meaning these falling dominoes do not care about international borders. Just to give you an idea of how crazy this interconnectedness is, during the 2008 subprime mortgage crisis in the US, small municipal towns in Norway nearly went bankrupt. Why? Because their local funds were invested in those toxic American bonds. What starts as a local problem instantly mutates into a global problem.
Finally, Section 6, the rescue. To stop this panic from becoming a permanent economic depression, authorities absolutely have to step in. Policymakers aren't choosing between good and bad options here. They're painfully choosing between bad and potentially catastrophic ones, which leaves us with one incredibly important question to ponder. When the financial system starts breaking down, who actually has the power to stop it? When the dominoes are falling, who decides who survives and who fails? It's a massive question, and exactly what we'll be exploring next time. Thanks so much for joining this explainer, and we'll catch you in the next one.